Mortgage points explained. So you're buying a home, your lender's talking about paying discount points, and you're wondering whether you should pay them or not. In this video, I'm gonna explain exactly what they are and how to determine whether paying discount points is gonna be a fit for you or not. If you're new here, my name is George Morales. I'm a licensed loan officer here in California, and I do these videos to show you guys that homeownership is still possible. So first things first, a discount point is an optional one-time fee that you pay at closing when you're buying or refinancing in exchange for a lower interest rate for the life of the loan. And 1 point is going to equal 1% of the loan amount. So if you have a $500,000 loan and you're paying 1 discount point, what that means is that you're paying a $5,000 fee at closing to be able to reduce your rate from what's known as a par interest rate. And that par interest rate is the rate that you would have if you didn't pay any discount points without any fees. 2 things to know about discount points. 1 is that the price, meaning how much fee you pay to be able to reduce your rate to a certain amount, changes every day. It's a lot like the stock market. Today you can look at interest rates and there could be a certain fee to be able to reduce your rate by 0.5%, but tomorrow you can look at that and that price may have gone up, or it could have come down depending on what the bond market is doing. The second thing to know is that discount pricing and points can vary between lenders. So not every lender is going to be equal. You're going to have your direct lenders, you're going to have your mortgage brokers, you're going to have your banks, your credit unions, and it's going to be different for every single one that's out there. Now, does it make sense to pay discount points? Like many things, it's going to depend on your scenario, but the first step in figuring this out is to find out what your break-even point is, which is how long it'll take to save the amount you paid in discount points by way of the lower payment. So let's say you have a $500,000 mortgage and your par interest rate is 6.25%. What that would mean is that your principal and interest payment is going to be $3,078 per month. Now, let's say your lender gives you the option to pay 1 discount point, and that is going to lower your interest rate to 5.875%, let's say. What that's going to do is it's going to put your payment at $29.57 per month for your principal and interest. So in this case, you're paying a $5,000 fee to lower your payment by $121 a month. So what you do is you take that $5,000 and you divide it by that $121. And what it's going to give you is it's going to give you the number of months it'll take for you to actually save $5,000 in your mortgage payment, which is going to be 41 months. Now, after that 41 months is when the true net savings will kick in. So now it's just a matter of asking yourself, will I keep this mortgage for 41 months or longer? Or do I intend to sell or refinance before that? If you sell or refinance prior to that 41 months, what that means is that you essentially didn't allow enough time to pass for that net savings to kick in, and you really just threw some of that money away. And the second question to ask yourself is, do you actually need the lower payment, or can you comfortably afford the payment at that higher rate and wait for interest rates to drop? If rates are projected to drop before the break-even point, then chances are you're going to end up refinancing. So it's worth considering taking that higher rate and then just getting the savings in your refinance. Hope this was helpful. As a reminder, I'm a licensed loan officer here in California, and I do these videos to show you guys that homeownership is still possible. And I love working with first-time homebuyers who are ready to be homeowners, but don't think they've saved quite enough to be able to buy their first home. See you guys.